I'd like to thank everybody for joining me today. Today, I want to talk about how do we build a tax-free retirement in a world where we have ever-changing taxes. And part of this is because we have the changing tax environment, planning ahead is what we want to be looking at. If you think about this, why are we even having this conversation? Well, part of that is you start looking at the US national debt. It's exceeding 37 trillion, almost to 38 trillion dollars. Well, if we have this rising debt, we've got a problem coming, and our clients have a big problem coming. The other part of this, if you start thinking about, we've got the rising Medicare, Social Security issues, state taxes are increasing. All of these things are growing in a way that are going to just be a bigger burden down the road. It's like, pushing that snowball downhill. It starts out a little bit small, but just keeps getting bigger and bigger as it rolls down the hill. That's what we're looking at with taxes today. If you look at this debt and start thinking about how is the US government going to address this potential debt issue? Well, number one, the government can start spending less. And we know, from history that isn't probably going to happen. Number two, government can raise taxes. And number three, the government can artificially devalue the dollar. Well, let's be honest. Out of those three options, number two is the most likely, that somewhere, somehow, taxes are going to go up. Well, we've got this debt and we have a spending problem. Taxes are the part in here that are always the moving target. So I want to look at this. Think about this. If you were a farmer, would you rather pay tax on the seed, or would you rather pay tax on the harvest? Would you rather pay tax on a smaller amount now, or would you rather pay on a bigger tax on that bigger amount in the future? And everybody, all of our clients are going to answer this a little bit different, but I think when you put it in these terms, most people would say, well, hey, let's pay on the lower amount. Well, if you think about qualified retirement plans, they let you take the tax break now while you have, write-offs from your business, or you have deductions because you have kids at home, you're paying your mortgage, all of those expenses that bring your marginal tax rate lower today. Well, when you get into retirement, your home's paid off. You've retired from your business. You don't have all those deductions. And Uncle Sam knows your marginal tax rate is going to probably be significantly higher because you have fewer deductions. Therefore, you're going to pay more tax at a higher rate on a bigger number in the future when you're actually in retirement. So think about this. If you're paying on the seed, what should we be doing now? Well, 2025, we've got tax planning happening now. We're in a low tax rate environment. Can we harvest some of those tax, future tax gains and do it today? Pay tax now while we're in these favorable brackets. So think about, can we convert, reposition, or plan around what we have now, so that we don't have those post 2025 tax rates that could be higher, and most likely will be higher in the future, affecting what our clients are going to do. So think about this. What are some year-end things we can start looking at? Well, number one, can you max out your Roth conversions or contributions this year? Now, converting to a Roth may not feel good, because we're triggering that tax now. I mean, we've got a taxable account, taxable qualified account that will be taxed whenever we access it in the future. Well, if we can convert it now at the known rate, that eliminates taking money out in retirement at an unknown rate. So if it makes sense, do that. If you have, a pass-through business, an S corporation, a partnership, those types of businesses, can you make those elections now on the pass-through income that will benefit your tax return? Section 199A, our qualified business income deduction, for closely held businesses, we should look at, what can we do to maximize that deduction to go ahead and reduce our taxes today on our business income? Then I look at accelerating income or deferring deductions. Can we stack those up strategically? And if I'm looking at this and if I have a high income tax this year and I do consistent charitable deductions, well, maybe I should stack my charitable deductions into 2025. So I've got higher charitable deductions this year, and that will offset my higher income. And one thing I look at with tax planning, number one, can we get out of paying the tax legally? If we can, great. Number two, if we can't, if we are going to owe tax, can we defer that tax to another year? Well, if I can pull back more income and create more deduction this year, well, I can bring my marginal tax rate down. So looking at accelerating or deferring income and deductions, some of those things make sense if we don't do it right. Fund your Roth IRAs or life insurance today for future tax-free access. And both Roth IRAs and properly designed life insurance, that cash value in that life insurance can be, it's going to be funded with post-tax money today. But when you access that money in the future, there's no income tax. And so looking at Roth IRAs, life insurance to create that future tax-free access is a great tool to start planning with today. And of course, I already mentioned this, leveraging charitable planning dollars today to offset our higher income. Now, as we start looking at this, and people hear tax-free income, tax-free access, what I want to make sure is that we're looking at this in a way that tax-free doesn't mean risk-free. These are investment type assets. These are things that need to be managed. So if we have Roth IRAs, we want to make sure, number one, we're doing Roth IRAs because of the taxes. We've paid the tax now, we get tax-free in the future. But depending on how you've invested that Roth, tax-free does not eliminate the market volatility exposure. So you need to look at what are those Roth IRAs invested in, and do they fit your personality, your risk profile, so that we've got a good asset and a managed risk asset. Cash value life insurance, they're again, great tool, but we want to make sure as we design it that we have it designed the right way, that we are funding it properly. That if we've committed to make ongoing premium contributions, that those are made as they're supposed to be, when they're supposed to be, and that we monitor that policy so that we start reducing or eliminating the performance risk. They're again making sure we've got the right asset and the right funding in place. Municipal bonds, they're again, they have interest rate and credit risks that we have to look at there to make sure that they match up with the risk profile of you or for your client. So when we're talking to a client about this, we want to make sure that we're making good, prudent diversification decisions so that tax-free is happening and we've eliminated as much of that future risk as possible. As you look at it, when you're designing your tax-free retirement blueprint, we need integrated tax planning. We want to make sure that we're monitoring this as we earn, grow, and distribute. Those are three different distinct areas that we have to make sure that we're planning for all of the taxes in a very integrated approach. And we want to make sure that we align your retirement, estate, and protection goals around the tax-free retirement. There again, we don't want to get into areas where we're doing maybe estate and asset protection that affects our tax-free investments as well. So all of this can align, but it takes planning. Finally, I like applying the DARE method. Make sure we diagnose the problem, analyze it, make the right recommendations, but ultimately execute those plans so that we have a coordinated tax planning, and it works into our state and asset protection as well. I appreciate everybody getting on. If you have questions, reach out. If not, we'll talk again next week. Thank you.